Welcome back, everybody. Your typical bull here, and today's a sad day. You just realized you're under PDT rule and you can't day trade. There's hope for you. I'm going to show you a SPY and QQQ specific strategy that takes advantage of vertical spreads and is just a overnight hold that is very similar to day trading, except you are buying at close and selling at open the next day or at some point in time during the next day. Pretty simple strategy and very low risk and high reward strategy. It basically takes very strong advantage of favorable risk to reward ratios. Basically, risk one, make two. Simple, basic stuff. Buy today, sell tomorrow, no problem. Alrighty. So first of all, before we get into it, we need to figure out exactly what kind of spreads we're going to be using. So we are going to be focusing on, for the purpose of this video, I'm going to assume that you have a smaller account since you are under PDT rule. So we're going to be focusing on simply $1 wide spreads for the entirety of this video. So there are two types of spreads we're going to be talking about. We're going to talk about the bull call spread, which is basically if I were to buy a one call for, let's say, $5 and then sell the two call for $3, I have a 1-2 bull call spread that I paid $2 for. So that is basically the first call, and then the other one is on the put side exactly the same. So if I were to buy the 2-strike put for $5 and then sell the 1-strike put for $3, it's the same thing, only this one is a bearish, and I would pay a 2-1 put spread for $2. Right, so let's look at some actual examples of some vertical spreads. So I'm using Webull. If you go to this little button here and click single vertical, what we have is, with this one set to 3, you change that to just 1, and then let's do 20 strikes, right? So this is specifically the call side, right? So 436, 437, 53, 46, 41, 33, right? So SPY is pretty notorious for making fairly big swings, especially lately. Like even just today, we're up $9.45. So anywhere in this sort of range here can offer us some very favorable, like anywhere between this sort of range here, I would probably hang in this area, can offer us some pretty favorable risk to reward trades that are, logical, right? SPY going up $3 or $4 in a day is not an issue, or SPY going down $3 or $4 in a day is probably not an issue. So this takes advantage of that. And then of course on the put side, we would be looking at this side. Alright, so let's just get right into it. So basically the whole idea of this strategy, right, is to basically, in its very essence, at the end of the day, you pick a direction and you buy a spread that you can get 2-to-1 risk out of, and then you just sell it tomorrow. So what I would do specifically, so let's assume this day's not here, yesterday, that's a pretty bullish close, right? It's a V-shaped pattern. We closed at 426. We don't have a real resistance here until around 434. So if I had bought like a 420, 428, 429 spread like in this area for about $25, this very next day I could sell it for very close to maximum profit, which would net me probably about a little better than 100% returns here. So if I pay 25 and the sold the next day for like 60, 75, that's actually a better than 100% returns. So that's kind of what we're aiming for with this strategy. So this takes advantage of the fact that SPY and QQQ have very short-term expirations, right? So you have a 1-day expiration here. This expires tomorrow, and a 4-day. So basically almost every 2 days there's going to be expiration options on SPY, so you can get these spreads that are very cheap, right? And it's generally pretty obvious which way we close, right? Like right here, you probably would have took bearish place. So the idea is to look for these clear candles, and on these clear days, take spreads, right? So like this is a very bearish pin bar. That follows through very well. This is a bullish pin bar that follows through very well. This is a very bearish close. It follows through very well. Again, this is a very bearish close, and it follows through well. And then you get a very bullish close into this day that follows through very well. And then same thing, this one probably would have resulted in a loss, but most of these, if you're paying, if you're just aware of very, very basic candlestick patterns, like this is a bullish engulfing pattern, and it closes next day much higher. Same thing again, closes higher, and then closes higher. And then so basically in this situation, you'd win 1, 2, 3 trades here, and then lose this 4th one, right? And then this one actually follows through as well by several dollars into the next day. And then this candle here, this is an inside bar. That's a very unclear candle. Same thing here, unclear candle, right? So you wouldn't actually take any trades here. You might take a bullish trade at the end of this day, but if you're paying close attention and you see that you're closing at a strong resistance level, you could probably pass on that day too and maybe look to something else, right? So this is a very bearish close. So what happens? It has a very bearish follow through. Same thing the next day. So that basically is the entire strategy, right? But I'll tell you guys some how to pick your strikes and things like that, right? So what you look for are these clear closes in one direction, one-sided closes really. So bullish, super bullish, bullish, resistance on this day, kind of a bearish close, so probably don't take that one, right? Same thing kind of in here. This is unclear price action, right? You have a very bullish candle. It does follow through the next day, but then you get an inside bar, right? So probably don't take that one. But most of these trendy kind of days, it's very easy to pick a direction on SPY, so we can take advantage of that, right? Like here, again, super bullish candle, huge volume, follows through very, very, very well. Okay, so this here, very bearish candle, follows through several dollars. Alright, so let's talk about the other time frame here. Let's look at an hourly time frame. So if you're also monitoring kind of the price action throughout the day, right, and we just go, let's just scroll back several days and I'll show you where you can practice this as well, just kind of picking your sides. Like you see, this day, super bullish close, follows through. You would have made pretty good a bit of money on that day. This is how you can kind of use the hourly charts as well. Same thing, super bullish close, good follow through. Not so clear of a who's in control kind of day here, right? So if we don't know who's kind of winning the day today, don't take the trade that day. Right here, this one kind of a super bearish close, but then it pops right there to open. So this one is more of a, discretionary type deal. Me personally, I would take this one short here. I don't actually know what happens, but this is popping right up into resistance, and it does look like it rejects it sort of close to the end of the day here. So at the end of this day, I would take this one short. See what happens. Yeah, follows through pretty good into the next morning, right? So this one, kind of a bullish close, right? You're closing close to view up, bullish all day. You pull back into the close there. So I would probably take this one to the long side. And it's flat, right? So it's close to probably a small loss there. There we go, super bullish close. That's definitely one you would want to take to the long side here. Probably long again here. Alright, super bearish close here. Definitely want to see for a short follow through into the next morning. And it does follow through, right? So, okay, let's talk now. I kind of feel like this is a very basic strategy, right? It's super simple. You just basically at the end of the day, kind of monitor how the day has went, kind of decide for yourself who won today, bears or bulls. If bears won, you want to take a put debit spread. If bulls win, you want to take a call debit spread. So let's talk about the specific options, right? So vertical spreads. So let's say the bulls win today, right? We're going to take the nearest expiration, but we don't want to spend 53, 45, 41 dollars, right? Okay, right in here, this 25 to 35 range, right? That's kind of the sweet spot, right? So 439 to 440. Today, if we were bullish, 439 to 440, right? We need SPY to follow through like $4 tomorrow. And what we would look for is to basically, depending on how many of these you take, if you have a very small account, just take one and just take small profits, right? Because you're taking on a very small amount of risk here. You're taking on somewhere between $25 and $35 of risk per contract. So what that means is if you buy this for $25, you have the potential to make 3 times that, right? So you can have an additional 75. So that's a 3-to-1 target. We don't need the full 3-to-1. What we need is for 25 to get to either 100% would be target 1 at 50, and then target 2 of course would be 75, which is a full-on 2-to-1, right? So 25 to 75 would be 2-to-1, 25 to 50 would be 1-to-1. So either of those is fine. Just keep in mind, if you do a 1-to-1, you have to win 51% of the time to make money. If you do a 2-to-1, you only need to win 4 out of 10 times. So if you think you can guess right 4 out of 10 times the direction of SPY, this is going to be a profitable strategy for you. So this is a very, very simple strategy. So for bullish days, we want the call spreads somewhere between, I don't know, 30, 25, 35 is the way to go here. And then for bearish, of course, we want the put side of that. So right in here, we're looking for same kind of story, the 30 to 25 range, right? So all we need is for SPY to drop into the next day for us to make a profit, right? So that is pretty much the entire strategy. It's super, super simple, and it actually works very, very, very well. You can do this almost every single day, and like I said, if you win even just 4 times out of 10, you're going to make money. So super bearish close, buy puts, sell them tomorrow. Super bullish close, buy calls, sell them tomorrow. Right? So right here's 2 days in a row you'd probably lose. This one you probably wouldn't take. Not a big deal. So let's just do a little math real quick. So if we pay 25, let's just say we pay $25 per spread, right? So $25 per spread, let's say we take this trade 10 times. Okay, so with a 40% win rate, if we sell every one of these that we buy at either 75 or 0, just let them expire worthless. So buy it, put a order in immediately to sell for 75. So if this expires, we lose $25. If this wins, we make 50 bucks, right? So 2-to-1 standard. Let's say we win 4 trades. So we make 50, 4 trades, that's $200 out of 10 trades that we would win. That's our gains. And then if we lose those 6 times, that is, what, 150? Math early in the morning. So yeah, that's 150. So what happens is with a 40% win rate, we end up making $50 in profit, which is pretty good. Now let's assume even the same scenario, right? We pay 25, we only lose 25 or win 50. Same options. Let's assume that our win rate now gets much better, right? So let's say we win those 6 trades instead of losing. So we're only going to lose 4 trades, so we lose $100. And we win the 6 trades. So in this case, what happens is we make 50, 100, 150, 200, 250, 300, and only lose 100. So if we improve our accuracy, this number continues to get better and better. And as your account sizes and grows, instead of taking maybe just one contract, now maybe you take two, then maybe you take five, and then maybe you take 10, and now you can see how this grows. You get up to 10 contracts, that's $2,000 extra a week with a 60% win rate. Not too shabby. So anyway, I hope this helps you guys with smaller accounts that are under PDT rules to maybe look at things a little differently and learn how to grow. But yeah, super simple strategy. Got any questions, ask them below. And please do remember to smash the subscribe button. I really appreciate you guys. Cheers. Oh crap, I forgot to turn that pen off.